Greetings and welcome to this special Rural Bank event, a virtual launch of Rural Bank's Farmland Values report for 2020. This report and the insights that it offers are a flagship activity on the annual calendar. I'm Lee Radford, former long-serving head of ABC Rural and someone who's been involved in broadcasting and specialist rural journalism for over 30 years. So today's subject is right up my alley, you might say, and like many of you, I'm keen to hear the latest. And as many of you probably are at the moment, I'm at home. So if you hear any dogs barking in the background, I apologise in advance. We're meeting, of course, online today because of the circumstances with the COVID-19 virus. But rather than that being an impediment, it's actually a unique opportunity to engage simultaneously with far more people than at a physical event. And I bet for many of you, it's going to be a very time-efficient way of gaining insights into this valuable report. And I hope the technology works well for you. There's also an opportunity for you to write questions to send us for the Q&A session at the end. So feel very welcome to do that. It's going to be interesting trying to get through the list of questions. There are the best part of 600 people involved in this event today, so there's plenty of competition for questions. In a moment, we'll hear from our three key speakers, Alexandra Gofman, the Chief Executive Officer of Rural Bank, Will Rayner, Chief Operating Officer with Rural Bank, and Tom Russo, General Manager, Real Estate with Elders. Rural Bank's Farmland Values report comes during an absolutely unique time this year. We're all well and truly in uncharted waters. There's been a seismic shift in society caused by the virus, and you'd have to say is entering a phase that none of us have witnessed. While that means uncertainty and challenges ahead, some things are rock solid, and I think you'll see that unpacked shortly. So without taking anything away from our speakers, Australian farmland has been a long-term value proposition, outperforming many other areas of investment. And while farmers in recent years have been holding onto their land and the total number of transactions is down a little, the value of farmland has gone in exactly the opposite direction. And that's despite drought, fires, floods, climate change, you name it. This is an asset class which has performed. So to set the scene, let's go straight to the top with Alexandra Gofman. I've known Alexandra for years, and she's a force of nature, and I mean that in a very complimentary way, involved in so many things, like being a director of the Australian Farm Institute, a member of the Prime Minister's Community Business Partnership, a former CEO of Foundation for Rural and Regional Renewal, and currently, of course, Chief Executive Officer of Rural Bank. Welcome, Alex. Over to you.
Great. Thank you very much, Lee. And it's an absolute honour to have you facilitating today's session, given your very long history with agriculture. I'm not saying anything about your age, but you are a very well-recognised voice across the rural Australian landscape. So thanks very much for joining us on what I think is a really exciting day to be launching the 2020 Farmland Values report. Now, it's fantastic that there are so many people online, and I really do thank you for joining us. It does demonstrate the deep interest in this topic and also the willingness of lots of people to try a different format because life has somewhat changed. So there may be a couple of technical glitches. We hope you'll bear with us as we work through a different medium of delivering this flagship report for us. Now, I think as we get through and you hear from Will with some detail about the report, this Farmland Values report really is a good encapsulation of the sector. For me, when I reflect on agriculture, it doesn't stop for anything. And COVID-19 hasn't stopped Australian agriculture in producing food and fibre for the country, if not elsewhere. And just like COVID-19, droughts and bushfires and other challenges may have disrupted and changed the momentum of the industry, but it's still continued to move forward. Farmers have kept farming, the supply chain is holding up, and we've all continued to be fed. So this really does debunk the myth that agriculture is volatile and uncertain. And I think sometimes we've really challenged how the industry is either self-portrayed or portrayed by others as something that's really unpredictable and always in crisis. Because the reality for many of us in the industry is that if you step back and take the long-term view, the value is there. And I think the Farmland Values report this year really does, again, demonstrate the underlying strength of the sector. When you take the noise out, agriculture is stable, it's consistent, and I think it's really very under-recognised in terms of a source of strong economic growth. If you're willing to see through those short-term variability and vagaries that is Australian agriculture. So on average, Australian farmland has delivered a compound annual growth rate of 7.5% over the last 20 years. That's a remarkable result, and it highlights that investing in farmland over the long term will deliver through both good times and bad times. We're not downplaying that the bad times are really tough for those that are in the industry, but over the long term, it's a really well-performing asset class and a great industry to be involved with. It does compare really well with other asset classes, as Will Rayner is going to unpack shortly. And we do know one thing, that just because the asset class is performing well, it does not automatically translate to profitability or growth for a particular farm business. It's the base asset for Australian farmers, and there are unique characteristics, strengths and weaknesses, and that every parcel of land requires smart, capable farmers to actually turn a profit. But with prices at historically high levels, how easy is that to do? And again, it depends on your investment horizon. It depends on the farming operation. It sort of depends on what you intended a piece of land and why. It depends on how it's financed, what your business structure is, and also your risk appetite. Another question is your debt to equity ratio and what you feel comfortable with and your finance partners, and the relationship with the bank to work with you with that risk appetite. So there's no right answers for questions. Farmers run their business operations differently. There's no comparing apples and apples. There are different degrees of success, and it's not easy. If it was an easy and simple game, we'd see a plethora of people wanting to do it. And whilst there's high demand, it still does require the gems to be successful. But the rewards are there. One thing is certain, people are prepared to give it a go, and there's strong demand, as highlighted in this report, even though there are these historically high prices. Transaction volumes have been extremely low, as you'll see as Will takes you through the report, and they fell a further 13.2% in the 2019-20 year. So we're going to ask questions as to what's driving this. Are farmers waiting to sell, particularly now that we've seen some reasonably good rainfall across the country over the recent months, or are they simply optimistic about the future and holding on? These are all really important questions and requiring discussion, and we're going to have a little bit of that today in the constraints of the time that we have available and appropriately moderated by Lee. So we do hope that this report contributes the evidence and the insight to have a really informed and robust conversation about Australian agriculture and farmland. And we hope the report really does dispel the myths that perpetuate about our sector. So, Lee, that's it from me. I will hand back to you. Thank you.
Thank you, Alex, and thank you for the... There are certainly some real positives in there when you look back over the last couple of decades and see what sort of there has been. And as you mentioned there at the end, Alex, also in recent months, we have seen some terrific rainfall across significant parts of the country. And it would appear that it's setting things up for a much better season for quite a bit of Australia. So we'll look forward to that as well. Well, our second speaker today is someone who I've also known for many years. He was an award-winning rural journalist, a Churchill Fellow, chairman of the South Australian Dairy Industry Fund, a director of Crop Forecasters, a favourite cricket club in Adelaide, and much more. He's both Chief Financial Officer and Chief Operating Officer with Rural Bank. To tell us more about the Farmland Values report, welcome Will Rayner.
Thanks, Lee, and good afternoon to everyone that's dialed in. Thanks very much for showing your interest in the Rural Bank Australian Farmland Values report. I will get into some of the detail of the report now, and perhaps start first with some methodology so people understand just what the data is telling us. before getting into some of the explanation of the underlying drivers of some of the results that we've seen this year. So it's important to note that this report is just a valuation tool, and it should not be constrained advice from rural banks. So please do consider that when you are reading the report. The analysis captures all farmland transactions in the calendar year. We've been doing this report, or this report goes back to data to 1995 and captures every Australian farmland transaction over that period. But our interest is very much in commercial agriculture, and it's limited to sales that occurred at an arm's length transaction. So to that end, we've removed all small block sales to limit the influence of the lifestyle set, I suppose you would describe it. So all those transactions less than 30 hectares in Queensland, New South Wales, Victoria and South Australia. All those transactions less than 50 hectares in Western Australia, and all those transactions less than 10 hectares in Tasmania have been excluded from this data set. It will also exclude those shires or councils that have large metropolitan areas to exclude the influence of that. And we've removed sales that are likely to include compulsory power. So, for example, where one party has been government acquiring the land. And we've also gone through and manually excluded some of the outliers. So, for example, if there was a tourism retreat or a conference centre on a small block of 150 hectares, we will exclude that from the results to make sure that we're not skewing the results that you see here. Other items quickly to note regarding irrigation, water and farm improvements. If the water or the improvement is on the property title, then it will be reported in the sale price and is therefore in these results. But if water is on a separate title, it is not captured. And the data here is reporting the median price per hectare, so not the average. So the median is the halfway point of the data set that we've collected. It's not the reason we use median. It's not as easily influenced by individual transactions, and it's less sensitive to usually high or low value transactions. And see here today are very much dependent on what has sold each year and very much the transaction mix that we see. So, for example, if it happened in 1 year, there was an unusually very poor quality land coming onto the market, then that will shift the median price down. But that doesn't automatically mean that all property has shifted in value. It just means there's been more transactions in that lower end of the market. When the results are aggregated at a state level, the median will be influenced by any regional concentration in sales activity. So it may not reflect every region in every state. So I would encourage you to get into the detail of the report to look at how the farmland values are in your particular region. You'll see that particularly in Queensland's results today. And very much what we're looking to do here is track the value of farmland over an extended period of time. We know that in agriculture there is short-term volatility. The long-term investment trends and growth rates are perhaps the most value through this analysis, and they certainly paint a very, very positive picture, as both Lee and Alex have referred to. So let's get straight into the report then. Unusually, I'm going to start with the volume of transactions because that really has influenced the results that you see here today. So because of the seasonal conditions that we saw across a lot of Australia in 2019, characterised by a lot of drought and dry conditions, you saw the supply of land coming onto the market fall pretty much across the board, nationally down 13.2%. But you can see in some regions that are drought affected, New South Wales, for instance, and those pastoral areas of Queensland and South Australia, some parts of Victoria, we're seeing transaction volumes the lowest that we've seen going back to 1995. So the lowest ever that we've recorded in central Queensland, northern and southern Tasmania, Gippsland and northern Victoria and central Western Australia. And that decline in volume is more pronounced at the lower price end of the market. So often as more marginal areas or the more pastoral areas, you've really seen the supply of transactions fall the most. By contrast, those areas that are in the middle or upper end of the market have held firm or slightly increased in volumes. So you've seen buyers prepared to participate, be particularly active for higher quality land, particularly chasing higher rainfall and or irrigation infrastructure. So you're seeing the supply of farmland fall in an environment where you've got relatively good soft commodity prices. The Australian dollar is falling, there's cheap debt, and there's high demand for higher rainfall in irrigation infrastructure. So how is that then translated into farmland values? And nationally, as Alex said, the median increased 13.5% over 2019. And you can see for pretty much right across the board, you've seen very strong growth. Queensland obviously influenced by drought, and I'll talk a little bit more detail about Queensland. And then in Northern Territory, you've seen a sharp increase in the volume of transactions in the pastoral beef cattle sector, and a corresponding decline in those amount of transactions in the higher value areas. So that's prompted the value that you're seeing there today. So for the land that did this, coupled with healthy balance sheets for a lot of farmers and low interest rates, you saw double-digit median price per hectare growth in most states. And the demand centred around quality land in each region, which resulted in a high proportion of high-value transactions in 2019. And that partly corresponded with buyers looking to diversify their climate risk and pursue land in regions with reliable water from both an irrigation and a rainfall perspective. Let's look at the value then of farmland over time. And you can see that the national median price per hectare increased 13.5%, now to $5,271 per hectare, and it's the sixth consecutive year of growth, setting there at a record high since we've been doing the research. The transaction volume fell by 13.2% to the lowest over the analysed. A total of 6.5 million hectares of land transacted with a combined value of $8.7 billion. You can see that you have a reasonably strong correlation here, or inverse correlation, between the number of transactions and the growth in farmland values. So the supply-demand dynamics working very, very well here. It is interesting to know when you've seen prolonged periods of drought that you haven't seen farmland values fall appreciably. Rather, you've tended to see farmland values plateau. And so we can talk about that perhaps a little bit in the... So let's look at farmland as an asset class then, and how has it compared against some other comparable investments. Both in the short and long term, you've seen that farmland values have held up particularly well. So the median price per hectare at a national level has achieved a compound annual growth rate of 9.2% over the last 5 years and 7.5% over the past 20. And they are excellent results when you compare them against inflation, obviously, for the residential property, the All Ords and the S&P 500 index. So across all states over the 20-year period, compound annual growth rate ranges from a low of 5.4% to a high of 7.7%. So the low being in Western Australia at 5.4% over the 20-year period, 7.7% in Queensland and Tasmania. And that 7.7% Queensland is obviously remarkable considering that they were slightly down last year as well. So you can see very strong growth and performance across the board. It's interesting to note that 1 year performance where you're seeing the very strong performance of the All Ordinaries in the S&P 500. In the year to date, obviously since this report was done, you've seen the All Ordinaries fall 21.2%. This is till yesterday at least. I haven't seen the market today. And the S&P 500 has fallen by 13.1%. So clearly you're seeing that short-term volatility, but again, those longer-term periods you're seeing farmland values stick up and hold up particularly well. Let's get into a couple of specific regions and see what's actually influencing some of these markets. So southern Queensland, like many regions across Australia's east coast, has been impacted by successive poor seasons. But despite some of those difficulties, the median price per hectare has remained resilient. And that resilience is probably unique to farmland in that sector, and you've seen some more volatility in some other land classes and residential property in particular. So in this particular example, the median price per hectare increased by 14.5% in 2019, and over the long term, the 20-year compounding growth rate sits at 7.8%. So you can see that despite tough seasonal conditions, land values can still experience growth. So across many of the drought-affected regions, we've seen very similar trends. We've seen lower value marginal properties have withheld. So those typically grazing properties and even the very broad acre cropping properties, farmers are not selling into a depressed market. They're waiting for better conditions to get their property on the market. So that skews the mix and the data that we're receiving towards those properties that are higher quality, higher rainfall, and therefore higher value. Less available land means that the competition is being concentrated on those smaller parcels, those smaller number of properties that do list, and therefore the properties that do sell are typically achieving stronger relative value. So when you look forward, you may see increased confidence in bringing grazing operations into this calendar year, particularly with some of the rainfall that we've seen, that you'll see more properties in those lower value regions coming onto the market. Conversely, if you look at an area that had a reasonable rainfall last year, we're looking here in southwest Victoria, they experienced more favourable seasonal conditions over the last 5 years, and land values have appreciated an average of 12.1% over that period and increased by 16.7% in 2019. Yet over the long-term period of 20 years, the compound annual growth moves out to 7.8%, so much more comparable to what we just saw in the prior case study of southern Queensland. So in higher and more reliable rainfall areas and for properties with reliable access to irrigation infrastructure, we're seeing strong demand from buyers, particularly graziers who are looking to diversify access to feed and water and looking to diversify their portfolios. And the appetite has been met by strong competition also from local parties who are looking to expand, to leverage existing cost base and infrastructure and human capital, buoyed by strong balance sheets, to get some of greater economies and scale into their operations. And in some instances, you're seeing additional competition from corporate and offshore interests, particularly for larger parts of the land. So there very quickly is a snapshot of what we've seen in results for the 2019 Farmland Values Report. As we go through the panel session now, I would encourage you, if you're online, to take a shot of the QR code in the top right-hand side, and that will take you through to our website where you can get further information and drill down to your particular region. So the Farmland Values Report does go into each shire across Australia or council region, so you can have a look at the longer-term averages or your neck of the woods. So with that very quick overview, Lee, I'll hand back to you, and thanks again, everyone, for dialing in.
Thank you for that, Will, and certainly a very rich vein of content there of quality information, and the extended report certainly does make some reading, but appreciate the overview there. Now to Tom Russo, who is Elders National General Manager of the Real Estate Division. A corporate lawyer and an agribusiness executive, Tom has extensive experience in project managing large-scale asset sales, and he's overseen some of the largest transactions in Australian agribusiness in recent years. Tom's previously been the chief executive of a specialist international law firm, and he knows more than a little about complex transactions, having practiced as a corporate lawyer. So to lift the lid on what's happening in the market at the moment and to provide an overview perhaps of the implications that COVID-19 may have and what lies ahead, welcome to Tom Russo.
Thanks, Lee. And thank you to Will and Alex for the kind invitation to join today's event. I think it's fair to say that this report is a much anticipated and quality report on everyone's calendar in the industry. And this edition is I've got a sneak peek, and it is no exception to the rule. Thank you for allowing our team of farmland specialists around the country to have a very small but hopefully important role in providing some ground truthing into the report, and we're here today. So I guess, look, you look at this report and you say there's another stellar run in land value appreciation around the country, and the obvious question that comes out of that is, well, how long can this go on for? And so Will and Alex have had the pleasure of presenting a whole lot of real data to you. Now I have the fun of actually trying to do a bit of crystal ball gazing and have a chat about, well, what might the year ahead look like and what might next year's report look like? The really key thing, and Will touched on this, that really comes out in this report, and it actually provides some data around some anecdotal evidence that we as agents were seeing in the market, is the reduced number of transactions, and notwithstanding that, the increase in value in farmland, even in areas where you were suffering from unfortunate extreme drought conditions. And I think that really shows the confidence that we're seeing in the industry, and also the view that investors have in this space, that this is a long-term investment, will ride out the cycles, and fundamentally over the long term we're going to win out. So what's it going to take to actually see a rebalancing of this? And that really is the fundamental question here. It's a supply-demand dynamic. Are we going to see a shift from this being a genuine seller's market as a general rule to a buyer's market? And to really get on top of that, we need to sit back and take a look at a number of the different key variables that drive our market. and to work out, what might happen in the future. So if I get it right, you're allowed to quote me this time next year. If I get it wrong, let's forget that we ever had this chat. But my view is that, a number of the key items we need to think about are market sentiment, cost of capital, access to capital, and when you wrap all that together, you can talk about the resulting weight of capital that's looking to be invested in this market, and then you need to compare that to what's happening on the sell side. So let's start on the buy side. Market sentiment. In my view, it's undeniable that our industry is very buoyant at the moment. There's strong confidence, and that's driven really by farm profitability, which links back to commodities and the fundamentals around demand for agricultural outputs. And we all know the story there. Every few months we see tens of millions of new mouths to feed on this planet, and they're looking for safe and reliable agricultural production, which we can contribute to. We then look at what's happening in seasonal conditions, and clearly it's wonderful to see a break pretty much all around the country, particularly in those regions where you've really been challenged by drought conditions and fires, etc. In recent history. I'm seeing enormous confidence in the marketplace. If you look at, say, the lamb and mutton market as a good example, there's extreme there. The restocker market's going to be strong, and we're going to see a lot of good returns for operators in that space. And we're seeing that start flowing through into land values, where we're seeing DSE rates as high as, over $1,000 per DSE, particularly in those really high rainfall strategic areas. I'm not saying there's not segments of the market that might struggle. Things like premium wine production or seafood production, etc., are areas where there might be some headwinds building. But I think as a general rule, those operating in agricultural staples are feeling very confident, particularly in light of the deterioration in the Aussie dollar, which, given our proximity to key markets, really puts us in a great strategic position relative to our international competitors. So then you look at cost of capital. As Will touched on, historical low interest rates. I think you'd have to be a very brave person to punt that they're going to go any higher anytime soon. And then you think about yield expectations from investors on the equity side. My view is that those are softening as people factor into account the fact that money is dirt cheap. There is a hunt on for yield in our segment of the market, and also in all investment markets. And I think that those have softened, albeit that they're at a reasonable level. Access to that capital, okay, it's cheap. Can you get your hands on it? From a debt capital perspective, I think our discussions with most of the major banks in Australia indicate that they view this section of the market as a safe haven. They're open for business, particularly banks like Rural Bank that have a very deep understanding of agriculture and their clients. They're wanting to support the industry. They're wanting to put money into the industry, and they're open for business, so long as the fundamentals are obviously there. Will touched on farmer equity. I think, in historical terms, we're seeing a situation where farm debt is extremely low, and that's as a result, and equity positions are high, and really that's as a result of what you're seeing in the data. Existing real estate portfolio performance is great. People are seeing growth. On top of that, a lot of producers have had good operational conditions that have allowed them to pay down debt. As a result, there's good firepower in their balance sheet that allows them to step into the market and take opportunities when they present. I think the large fund managers that are in the market are very well set. We've got, I guess that industry's matured in recent years. My view is there's some really excellent operators in the market with really good executive and operational management teams who have a good, strong track record now and are backed by investors, the likes of Viridis, Warrakiri, etc. And I can't see them losing interest given all the fundamentals in the industry, or losing ability to attract capital. So, does capital dry up from the likes of super funds or pension funds in North America, etc., who are looking to preserve cash as we move into uncharted territories from an economic point of view? Maybe. But my view is this industry represents a very, very attractive proposition in these turbulent times. and one that is a safe haven that's uncorrelated to a lot of the more volatile asset classes. So my view is there is still a big weight of capital that's looking to get set in Australian agriculture across pools of capital that we have never seen before in terms of diversification and number. And I'm talking about traditional farming families right through to institutional investors, all looking to deploy capital into our industry. So the buy side looks pretty rosy. You then say to yourself, okay, well, what's happening on the sell side, and can that balance this out so that we're actually seeing, a move towards a more buyer-friendly marketplace? Sorry to the buyers out there, my view is that it doesn't. I really can't see a fundamental or material shift that will really force that balance. Yes, we are definitely seeing increasing liquidity into the market. Our network is seeing activity, particularly in formerly drought-affected areas where farmers are saying, okay, things are looking rosy, my farm is presenting a lot better than where it was a little while ago, I'm going to make the move now. However, equally, there are a number of farmers who are saying, thank goodness, now is my time to start making operation, not leaving now when things are actually looking good. So the extent to which that liquidity increases is yet to be seen. My view is it will, but it won't be material enough to soak up all the buy-side demand. So I'm not seeing a material rebalance in that. I think the other thing we need to look at on the buy side is willingness to pay, and I think this is the reality of where you're going to see perhaps a cap on growth. The reality is people are not going to keep paying 20% capital appreciation year in, year out, and start seeing return on investment squeezed and squeezed and squeezed, no matter how much. So that's really where historically we've seen in this marketplace, it's almost self-regulating in a sense, that over time it will balance itself out. People won't pay silly money if they're not getting the returns. So my view is that that is probably what we're going to start seeing shortly, where in different segments, investors start saying, right, my apologies, Murphy's Law. Hopefully I'm still online. My view is that that is probably what's going to see a slight slowdown in what's happening in the marketplace. But again, I don't view it as a negative impact on values, potentially sideways, but more likely just a more modest increase in values. Over to you, Lee.
Thank you very much for that, Tom. And you've made me double check my phone as well, because I had that in my pocket and it wasn't on mute. So it happens to the best of us. Thank you very much. It's really great to see some of your insights into what's actually happening in the market at the moment, and also your thoughts about what lies ahead in the year that's presenting itself to us at the moment. So we'll go to questions in a moment, but I just wanted to let everyone online today know that this webinar is being recorded and it'll be available later. Go back into it and to view it again. So it's not just a once-off. You'll have the capacity to revisit this at your pleasure. So to questions now, and I'm pleased to say that we've got many questions, in fact, way more than we're ever going to be able to get through in the time we've got available to us. So what I'm going to do is try and pick out some of the key themes and some of the key questions that appear to be coming through from all of you who are asking this afternoon. Now, the first of those is, what's the underlying reason for the hike in land values abroad in Australia, with some industries not enjoying a substantial lift in long-term commodity prices? So, Tom, perhaps back to you on that one.
Sure, and I'm not sure if Will has some views on this as well. I mean, I've probably answered or given a good taste of what I think is going on. To specifically talk about those segments of the market that perhaps haven't enjoyed commodity price rises to the extent of others. My view is it's quite simple. People are taking a long-term view. People are looking at the demand dynamics for agricultural staples globally in the medium to long term, and they can see that fundamentally it's a great investment. It's a real asset. It has high levels of security, relative low levels of risk, and that's Otherwise, I think, all the variables that I talked about during my Outlook session probably apply to that question.
Will, you've been going over the data with meticulous attention to detail. What are your thoughts around this particular question?
Yeah, I agree with Tom's comments there. It boils down, I suppose the other way of phrasing the question is, why is land value not correlating more closely with commodity prices? And I reckon there's 5 reasons that you could put it down to. We've touched on supply, so there's fewer farmers into this market. But there's also a fact that there's less arable land globally each year. We look at a lot of our urban sprawl as some of the best agricultural land that we've got in Australia. And there's also going to be less water. So there's less supply of those physical assets. So there's going to be, so people are going to be concentrated in where they can access land higher rainfall. Tom mentioned that the cost of debt, it's never been cheaper globally. So the official cash rate is the lowest here. But globally, interest rates are the lowest they have ever been. And literally, you can search a couple of millennium into history, and you still don't see anything like the rates that we've got now for the cost of debt. We're also seeing the land use change. So farmers are buying and are able to take land that was used for perhaps a less valuable commodity or production system and transform it into a high production system or commodity. You're also seeing those farmers change scale, so particularly that neighbour competition, which is very, very prevalent. They're able to add a parcel of land into an existing operation, leverage the same fixed cost base, the same plant and property, and in some instances, labour base, particularly those family farming units returning kids onto the farm, for instance. And then finally, efficiency. So farmers are able to do more with less or more with the same. So I think those factors are also influencing what you're seeing with farmers' earnings.
Thanks for that, Will. Now, not surprisingly, COVID-19 is a common theme in some of the questions that we're seeing this afternoon. And the question here is, how do you see the COVID-19 pandemic affecting the input costs, export markets and commodity prices of the various agricultural sectors over the next 12 months and into the future? And clearly there's a leadership role that's going to have to be played here as well. Perhaps, Alex, I might come to you on that question, please.
Yeah, thanks, Lee. Look, I think it is the question that is on everyone's lips because we are all living and breathing it, irrespective of what role or location across Australia. So even if you're not involved in agriculture, it's something that is disrupting each and every life. And also the challenges we've seen globally with people concerned about having access to food has exacerbated the concerns about the security of the Australian agricultural system. I think it's actually given us a platform to be able to highlight the absolute strengths of the Australian agricultural industry and the players within the industry. Just like banking, agriculture was identified as an essential service and therefore supported to ensure the supply chain and the value chain could continue to operate irrespective of the various state and national restrictions. And it does allow us to tell the story about an exceptional industry that unfortunately over the last few years has only been in the media for the negative challenges that it's been facing. But it is, as Tom said earlier, it is a safe haven. It is a great place to be investing because of what it provides for society in terms of food and fibre, but also in terms of the asset and the financial returns. If I respond specifically to this question, from a demand point of view, many commodities will probably see a decline in the coming 12 months, largely linked to export market disruption. We know that for a period there really was a halt on any plane or ship leaving the country's shores, and that's obviously been slowly opening up again, but there will be some flow-on impacts to that disruption. The closure of hospitality, so the restaurants and cafes, etc., that will have an impact on those who supply into those entities. And also, as we see so many individuals impacted with reduced employment, and we're tipping the country's anticipated to have about 10% unemployment rate. So that will have a flow-on impact for a large cohort of consumers that really do rein in their spending in uncertain times. So that's likely to see a decline in the demand. But this is actually really combined with the prospect of favourable seasonal conditions in Australia, and it's fantastic to be able to say that because we've had some really challenging seasons and consecutive seasons for many parts of the country. So that suggests that that combination of favourable seasonal conditions, a bit of a decline in demand, supply will be up. So what's the likely outcome of that? Well, softer commodity prices. So that doesn't sound great, but then when you temper that by the lower Aussie dollar, that's going to really aid export recovery, and also the historically low livestock numbers that have kicked off 2020. So commodity prices are, however, coming off really high levels, and in most cases, that's something that will really help on farm profitability. From a farmland values point of view, a softer commodity price outlook could slow demand, but the two have tracked together over time when you look at this report combined with some of the other Rural Bank commodity reports. However, we're coming off the back of very low transaction volumes, as Will highlighted, 13.2% decline. And so this has increased demand. And it may lead buyers to look past that softer commodity price outlook in order to secure quality land for future returns, as Tom highlighted. So I think when there's lots of swings and roundabouts here, but if we look at there's a decline in the demand through the softening of commodities, the favourable seasonal conditions, the lower Aussie dollar, the low livestock numbers, we do believe that that combined with the low transaction volumes, people will still see through that, look at this report as the underlying asset is continuing to perform strongly, and people will still make really informed decisions and be able to still have access to markets, and with the right skills and capabilities under their belt, be able to turn a profit. Tom, I know that Elders Rural Services is involved on the ground and been supporting that supply chain and value chain for your customers across the country. How has COVID-19 impacted sort of operations from a day-to-day perspective?
I think for us day-to-day, as a network, pretty much open and it's business as usual, whether that's farm suppliers, real estate transactions, things are happening as per usual, just with obviously a big focus on safety, both for our staff, our team members and our clients. But our clients are doing what they do well and doing what provides Australia with so much security. They're getting on with farming. And we don't really see any interruption to that. We did see initially some supply disruption in the farm input space where, agricultural chemicals or fertiliser production had some disruption, particularly when China went into lockdown. That has largely come through the system now. And our farm supplies experts are really telling me that the main disruption now, the main challenge now, is we've just got the break of what looks like such a wonderful season. That demand for crop protection or fertiliser has gone through the roof, 30 or 40%. And so, we're needing to get on top of that. I think we're positioned well, and we're not expecting that we're not going to be able to provide the necessary inputs into our farmers. So it all looks really rosy from that perspective, and we're not seeing anything that concerns us.
Tom, just a supplementary on that, if I may, because so many in society are worried about the uncertainties that lie ahead. We're being told from all quarters that the economy is really smashed through this event, and that is compounding on a daily basis. But you seem to be saying quite the opposite about agriculture. You don't seem to be at all concerned about it. Is it as simple as people need to eat, Tom?
That's our view, absolutely. You know, and that's what our farmers are saying. And to be honest with you, it's even more heightened because a lot of people have been sitting there waiting for good seasons, and they're not going to let this break go to waste. So they're saying, let's get on with it, and let's take advantage of some good conditions while we've got them.
That's great to hear, that sort of positive outlook. It really is encouraging in the current environment. Now, the next question that I've got in front of me is about water security. How has water security, i.e. the security of ownership and access, changed farm values, particularly with high-intensity cropping or permanent planting? And I note, Tom, at the beginning, you made some distinctions about what was in the survey. Tom, if I can come back to you on that particular issue, though, what do you make of that question?
I reckon that's a great question, a really insightful question, and one that exercises a lot of people's minds, including mine, in this marketplace. And I've probably debated that issue at length with many valuers, some of whom I know are on the call today, in relation to that link between water and land. I think, look, at a very basic level, you've got to say that access to water clearly is a massive determinant of the value of land. And you can look at a basic level and say, you know, marginal or pastoral land and the per head value or carrying value on that country versus, say, you know, really safe inside high rainfall country. And you just look at the different values paid on a DSE or a beast area basis, and you can just see the impact that reliable water has. And that's water from the gods, right? So then you move down and you look into permanent plantings and intensive irrigation and regulated water markets, and it becomes even more complex. I think this water market has matured. It's obviously been subject to a lot of controversy, but one thing that's happened is it has matured, and people are starting to see water as a real asset in its own right, as a capital asset. And so when you're making a decision investing in one of these properties, it's not just about the land. The water is as important. And you're saying, how do I get a return on investment or return on capital here that's acceptable to me? And in doing that, you're looking at both land and water. So logic would tell you that the higher you're paying for water or that water portfolio, the more pressure should come to bear on land value and vice versa. Now, the problem we have is that a lot of those transactions are inextricably linked, where people are paying a price for land plus water. And so it's difficult to actually quantify the impact. And I think the other thing there is it's probably the case that people aren't actually allocating values as between the assets. So it's hard to get transparency on that. I reckon probably the best space to look is actually greenfield sites where people are buying properties with a view to developing permanent tree crops on it that come without water, and say, well, what's happening in that market? And that's been really interesting. So in sort of 2017, you saw a massive amount of investment going into greenfield permanent tree crop sites with a view to high value land change or land use change. And then all of a sudden we entered drought. Water became very difficult to secure, and it was extremely expensive, and it appreciated at an incredible rate. And all of a sudden, we saw all of the capital hunting for those sites in the market completely disappear. And even to this day, I think it's fair to say that we haven't had a balancing out yet where we've seen the land get to an acceptable level where people are saying, I'll buy that developable land for X dollars per hectare on the basis that I'll take the risk that I can go out and find a necessary water portfolio. And land was getting to, you know, $10,000 a hectare undeveloped. On the basis that people saw enormous upside in the arbitrage in developing and planting permanent tree crops. So look, that's a long-winded way of saying, I don't know, I can't quantify it, but it is absolutely inextricably linked, and I think it's only going to become more and more acute as the years go by and water becomes more important.
I think it was a really insightful answer to the question, actually, Tom, and get that intelligence from your company, who is, really at the coalface on all of this, is absolutely valuable. Will, is there anything else from your perspective that you'd like to add on this particular? Because obviously so much effort goes into the production of this report each year. Any more insights from you?
I think I would echo Tom's comments there, and from a bank perspective, increasingly banks are viewing water as a distinct asset class, and increasingly it's forming part of the, I suppose, the security or the of our customers, and then we're looking at going forward. Perhaps the only thing I'd add is that water isn't always seen as necessarily adding extra profitability, but it's also being seen as a risk management tool. So that's sort of driving some of the fundamental reasons for these purchases. So as much as it would be nice to be about increasing the top line for a lot of farmers, it's also about making sure that we're managing the downside risk so that they're buying living haystacks effectively in some instances, or diversifying their operations. So that's also driving some of that demand. That's an additional point I'd make on that one.
There seems to be a bit of a theme coming through in questions around corporate investment as well. This question is, to what extent have land values been driven by corporate investment? How have investment yields changed over time, excluding perhaps capital appreciation? And I guess, Tom, really that's tailor-made for you.
Yeah, I'm happy to go again. Again, I reckon that's another really good question, particularly given that we have seen, as our farmland market has matured and we've seen a lot of interest from investors, this has become quite a controversial issue. My view is it's probably too high a statement to say that corporate investment is driving farmland values in Australia. I think I'll probably go back to my earlier statements about the weight of capital. Now, that capital is coming from everywhere. Coming from family farmers, domestic corporate farmers, institutional investors who are making, astute investments through really well-established now local intermediaries. So, to me, there's a weight of investment in this market. Now, some markets, absolutely for sure, you've seen more corporate investments than others, and they probably are driving values. And I think of a good example being WA, broadacre market, which presents a good opportunity for corporate investors to enter a market at scale and get set. Esperance is a great sub-region there as an example, which is dominated by corporate farmers at the moment, and the vast majority of transactions have been. But, Will and I were talking about this earlier. I think we've also seen strong evidence of family farms actually quite often beating the corporates in this marketplace. And there is a perception out there that maybe corporate farmers can pay over the odds. I would dispel that. My experience with most corporate farm investors in this country is that this has been an investment space that has matured. There are really high caliber executive and operational management teams in these institutional investors or these fund managers who make very disciplined, very sound investment decisions. They're not just out there throwing money around. And quite often, local farmers have a strategic advantage. They have neighbouring properties. They're looking to, they've got existing cost base that they can leverage, and they can actually, and quite often do, beat the corporates at their own game. In addition, the corporate space doesn't have that emotional link or that, multi-generational view to farmland investment, which sometimes allows people to pay over the odds to secure a highly strategic piece of land for their family or their corporate or their family operations. So, I can think of some really good examples in recent times that I've been involved in. I think of probably one of my favourite transactions was an off-market transaction where I introduced the tilapia aggregation in Victoria and South Australia to the McBride family, a wonderful Australian farming dynasty who stepped up and bought probably what was the biggest Victorian land sale in history. I think of the Vella family, where Rob Morello and I up in Proserpine put a huge beef production and sugarcane aggregation to the market, and this family stepped up and acquired that over a number of corporate investors. The Millington family, who recently acquired a huge and incredibly high quality cropping and grazing aggregation in South Australia. These are all wonderful stories about families who are confident, they can see where this industry is going, and they're making big investments. So Australian farming families, as much as anyone, are driving the increase in value, and it's all off the back of strong fundamentals and our industry being a really attractive space to invest.
Great examples there. Thank you, Tom, for those. And we're rapidly running out of time, so I think perhaps just one more question to squeeze in now. And it's another emerging theme that's really coming through with questions, and it's around young people. This is a perennial one. It's been a question for as long as I've been involved in reporting on agriculture in this country, and that is, how can young people actually get access to the land? How do we, when you are looking at an asset class like this, which is performing so well and is so valuable? Alex, what are your thoughts?
Thanks, Lee. And I think whilst it is a perennial question, if we ever stop asking this question, I think we would have to be concerned, because if it's always a question, it means that there's always interest, and we're striving to improve how we bring young people or new entrants into the industry with new passion and enthusiasm, etc. So I'm kind of glad that it's a perennial question, because it means there's the interest to improve, not just roll out the red carpet, but improve how we can bring talent into the industry. So I think firstly, we do actually have to attract the right talent. We do want to get the brightest minds into the industry. And part of that's about how we sell the industry and the opportunities within the sector to all of those people that are thinking about how to build their careers. So not just those who have come and grown up on a family farm, but all the others that really underpin and contribute to a dynamic and vibrant agricultural sector. I think we need to make sure we are investing in training and skilling and building capabilities to run what is now a very complex, sophisticated, dynamic business. So essentially we are training and recruiting and building a whole plethora of CEOs for really complex businesses that have to do more than just put a crop in or raise an animal. It is a really sophisticated, fast-moving sector. So then it's about making sure that we are providing the right access to capital. And that is one of the biggest barriers to entry, as you've just highlighted. Many of the questions are about, how do I get in? How do we access capital when I don't have a track record? I don't have the security behind me, etc. And I think we need to be thinking about different business structures and deals. So we have to be a little bit more innovative, just like COVID-19 is forcing many industries to innovate and pivot and think differently about how they use their current skills and capabilities and how they structure their business. We need to do that in agriculture as well. So we do need to think differently about buying and selling and leasing. We need to think differently about equity and ownership structures. And I think that's not just thinking about it from if you're in the industry and already have these assets, or you're wanting to access farm assets, but the financial institutions that are providing the capital also need to be really thinking and open to different types of business structures, deals, and transaction arrangements. And then finally, I think one of the critical things that we often talk about, but we don't really put critical thinking into it, is succession. And making sure that, because these are complex businesses, and if they are either corporate or unique business structures or even multi-family arrangements and generational arrangements, that means unpicking a lot of emotion, as Tom highlighted, different social structures, different business structures, and that requires dedicated investment and expertise to support that succession conversation. So there's actually no silver bullet here, but there are a couple of steps that we should be looking at from training and attracting right through to supporting exit and transition.
Thank you, Alex. And unfortunately, we are just about completely out of time now, but I don't want to leave this without allowing each of the three of you to make some summarising remarks about this report and where you see things heading in the year ahead. I mean, we've already done that to an extent with the presentations and in some of the answers to the questions, but just in summary, Will Rayner, your thoughts?
I'd just like to thank everyone that's given up some of their time to attend this, I think, and also to acknowledge and thank Elders and Tom as our partner in putting the report together. Overwhelmingly, it's a positive report for Australian agriculture. It shows that our sector is quite resilient and robust and well set up to deal with the volatility we've got. The different side of this same coin is that clearly those issues that Alex raised around succession planning and new entrants think we owe it upon ourselves to all turn our minds to our structural challenges that we're all facing. So, but overwhelmingly, this report shows that I think we're in a pretty good shape. And as far as a prediction for the following year, plenty of rain and lots of full silos and plenty of wool bales, I think would be a good start. So thanks, Lee.
It sure would be. Hallelujah to that, Will. And final remarks from you, Tom?
Yeah, look, well, first of all, I'd like to reiterate my thanks for the invitation today. I think I've probably rabbited it on too much as it is. Having said that, if you would indulge me, I think the only thing I would like to add, given the audience I've got before me, is to say a big thank you to all our primary producers. These are harrowing and uncertain times, and in the midst of it all, we've got this wonderful agricultural industry that is providing secure food, which is so fundamental. And I know that particularly, in my generation, I don't think that the importance of our agricultural industry has ever been more profound and more understood, particularly from people in the cities. Thank you so much to all of you for everything you do for our nation and for the security that you are giving us all during these really difficult times. So thank you.
And hear to that, Tom. Thank you very much for those comments. And last, Gofman.
Thanks very much, Lee. Well, I think the report highlights that we've got a really strong asset base, and from all the comments that we've heard over the last hour, the outlook is pretty positive with seasonal conditions, and I think great sentiment in the industry of capturing some opportunities. I do want to say that you can have a great asset, but if you don't have the skills and the capability to actually appropriately manage and make informed and robust decisions around that asset, then it will be really challenging to turn a profit. And profitability is often where what each of the business owners and farmers and bankers are really looking at. So there is still that we've got to do something with the asset, and we need to have the skills and ability to do that, because the profitability is there, because the demand is certainly there globally. I highlighted the access to capital challenge for young people. I think that's broadly, an access to capital challenge, and I don't think it's just up to farmers to restructure and think about how to use capital differently. It also is beholden on financial institutions like Rural Bank to lean in and also modernise and innovate in how we make capital available. And finally, this report is about providing data and insights to inform decisions and to inform debate and discussion. So we're not, this is something that I'm a passionate believer in, that you cannot have a robust debate. You can't make really solid decisions unless you've got data and evidence on those to go along with the great gut feel that many people have in the industry. So I want people to make use of the report to inform decision making and to inform really lively discussion and debate. And Lee, I know you highlighted at the start that we've had lots and lots of questions submitted. There's a commitment from Rural Bank that we will make available through the website where you can access the report. We will respond to a number of the key themes that have come through those questions, so that the questions that people have taken the time to submit either over the last hour on registration, that we actually put some effort into responding to those. So we'll commit to doing that. Thanks, Lee.
Thank you, Alex. Thank you for that commitment, and thank you for such good information. From my perspective, it's certainly been a really positive hour, some very strong and positive messages coming through about agriculture, the property market, and so much more. Just a reminder that this webinar has been recorded and it will be made available after we've finished here this afternoon. Thank you to who have posed questions. We have been really blessed with questions, so many of them, and absolutely no hope really of getting through such a vast number. But we really do appreciate you reaching out and asking those questions, and we'll do the best we can to get back to you on that, as Alex has suggested. And thanks, of course, to our speakers this afternoon, Will Rayner from Rural Bank, Tom Russo, Elders, and Alexandra Gofman, the Chief Executive Officer of Rural Bank. Thank you to Rural Bank for this opportunity, And to the many hundreds of you that have joined this webinar this afternoon, thanks for your time, thanks for your interest. May it continue to rain in your part of the world, and may we be blessed with a great season in 2020. Thank you so much. I'm Lee Radford. Good afternoon.
Thanks, Lee.